Hey, welcome back, everybody. And yep, it's the week before Thanksgiving. So next week, not sure we're going to have a video. Well, we might if I get, super excited about what's happening as far as this week with mortgage rates coming down and buyers coming out of the woodwork, which is awesome because today we're here to talk about with mortgage rates coming down, applications are on their way on an upward trend, and buyers have been coming out of the woodwork. Now, you might be saying, George, how could that be? Well, we have constantly had this pent-up buyer demand. It has always been there, and truly, it has been subject to the interest rates that we've been seeing on a day-to-day basis, week to week, because remember, the interest rates go up and down like the stock market. Follow the 10-year treasury. As the 10-year treasury goes up in value, so do interest rates. And when they come back down, so do interest rates. Now, they are not tied together. Just funny enough, they mirror each other in a lot of ways. It's a great trend to watch. But since we've gone from almost 7.898%, we've actually dipped back down into the mid sevens, low sevens. Some programs below 742,000, they're in the high sixes. And so what the expectation is over the next few months is we're going to kind of see this bubble along type of activity because some of the earnings reports that we're seeing and inflation reports have been better than projected. And just remember, the report that the feds look at, I think, is skewed a little bit because it's not true inflationary numbers. But nonetheless, it helps us. So we'll keep them on their path. And rates came down because they weren't doing an increase. In fact, they may not do another bump in rate, although I think they may do a 0.25% rate, 25 basis points, in the month of December. Maybe. Now, the pullback is commercial loan delinquency is actually on its way up. Completely expected because rates have gone from near zero to about 5.5 prime plus. Add 2 to 3 points on that. That gives commercial lending not the 3 to 4% rate that they've enjoyed in the last 5 to 7 years, but the ones that are refinancing now or have to refinance because it's not like buying a home type of mortgage. You get much shorter terms, okay? And that means that these guys are now refinancing at sometimes 2.5 times the borrowing costs that they had before. And that hurts. And many times they can't make things pencil at that point. And so then we have delinquency issues. Anyway, moving on. All right. So let's take a look a little bit about what's going on with our chart. Let's bring this up. Whoop. That was the wrong button. There we go. Actually, let me put myself up above. Again, everything that we're seeing here, we're seeing some super positive trends. And in fact, when we take a look at these numbers here, so this is current versus year to date. We're down 25,000 homes, or about 27.5%. Sales are off 17,000 homes, or about 25%. And then, of course, 13,000 less pended sales. But if we take that and we roll over from month of November to month of November, year over year, all right? Look at this. We come down here. We're actually up as far as pended sales go. And that is a big deal. And you might say, George, why is that a big deal? All right, because when we take a look at the 7-day running average, look, just in the last 7 days, 664 homes on market. But 935 still went pended, and we had 712 closings. However, when we roll back up, we can see that our price reductions are at 503, and then 133 came back on market. Those are homes coming back on market that basically the buyer canceled the sale and the home is back on market for whatever reason. Could be any number of reasons, okay? Now, the super important thing to keep in mind is the fact that we still have more pended homes than we do homes coming on market. Not uncommon seasonally this time of year. That's a very common trend. Now, what's important to consider about that, if you're looking at new construction, so if we roll over and we take a look at, let's bring up whoop, I did it again. Hang on a second there. All right, let's bring this back up. Okay, so when we take a look at new construction, we can see, let's bring that up, there you go, that we're only 7.9% down, or 166 homes, right? We have 271 more homes on market, but look at this. We are only 248 homes off for sales, but this whopper of a number, 1,331 pended sales more. Now, when we go over and look at what we did the same month of November, look, again, our active market is down. Our new on market is down by 4 homes. Solds are up by 4, and we're up 39 homes just for the same time in November as to where we're at today. And when we take a look at that, what's super important about new construction is that all of your big resellers, okay, all of your nationwide builders, and including, your other builders, like I like Charlie Connor's Homes, Connor Homes, even though he's stepping away and letting people manage, he builds a great product. Okay. So does John Stackman, who does more of a custom home, and Greg Arms. Again, they do an amazing job, but the bulk, or I would say probably 50% of your homes, your D.R. Horton, which is also Pacific Ridge and a couple other subsidiaries. You have Lennar, you have Toll, you have Pulte, you have Quadrant, which I think is now TriStar. So all of these big builders will make up about 50% of the inventory that's out there. And if you have an agent that works and understands new construction, how to maximize, and we say maximize, an additional $5,000 to $20,000 worth of added benefit to an already existed price point, if they're not familiar with how to do that, you may want to start interviewing a different option or two, right? Anyway, just saying, they are willing to offer you some incentives, most of that as a rate buy down. So we're seeing rates anywhere between 4.99 to 5.5%, because they have to report to stockholders and they need their product sold. Best time between now and the end of the year. Plus, rates are right there where you need it to be. Plus, with it coming down a little bit, it makes it and incentivizes the builder a little bit more with other options. They're less inclined to move on price. Just understand that. They're more incentivized for rate, for closing cost credit, for additional upgrades to a home. Just options to consider. All right. Now, all this rolling around, we kind of hinted last week that November 30th is going to be a big day. Some of you are saying, George, why is that a big day? A big day because that is also going to be where we look at bank-owned and REO properties. Why is that a big deal? Well, let's go through our metrics first. So let's take a look at our running day average here, 7 days. Look, we're 19 homes above inventory-wise, 32 as far as new on market for the year to date. But if we roll over, look at this. Same month of November, we have 21 homes more. Look at that, 131% more. Some people go, oh my gosh, crazy's horrible, or November's horrible. Now, when we look at that, it's 8.8 and 15.4%. All of our numbers are up, but these are tiny numbers. And why we're not concerned about those right at the moment is because we should be seeing, like, if we had a problem, we would have like what we did in 2008, where we had hundreds, almost 1,000 homes that were in the mix as being bank owned. And we don't have that. We are so low. We're like 2%, maybe 3% of where we were in 2008. Even pre-pandemic levels were super low as far as inventory, as far as bank-owned homes. Now, November 30th, super important. Pay attention. The CARES program, CARE is an acronym that has been protecting a lot of the folks that were in default for any number of reasons. That comes to an end on November 30th. That is super important because then all of the protections that were given go away. So people that are in what we call serious delinquency or greater than 90 days delinquency, they tend to be a little bit more in jeopardy, albeit financially, their home should have plenty of equity. they need to make a move. They need to make that adjustment. So the notice of defaults, notice of trustee sales will be happening, that we will see a bump in activity. Fully expect it. No, the sky is not falling. The floor will not fall out because still, all things considered, our area is really good. Heck, we only had 30 notices of trustee sale in the last 30 days. That's one a day. That's nothing. Okay. It's horrible. Don't get me wrong, but that's small potatoes. We've been averaging between 26, 40, 30, somewhere in there, over the average, basically since June. And each month, as we track this and take a look at our trend, it will be interesting to see what happens after November 30th, as we roll into the new year also. So with that being said, if you have any questions, make sure you put it down below. Ask those questions. We get back to you within about 30 minutes. The other thing is, let's open this up. All right. We want to make sure that we take a look at our lending criteria, right? Look, 30-year money right now, 7.37. And that's actually up just a tiny little bit. Last week, we were at 7.5. Freddie's at 7.44 right now. Now, understand, rates have been coming down, about a half a point, 3/8 of a point. It's going to bobble around next week as we start heading into the holiday. And then we are going to see a little bit of shift. We'll see what starts to happen or what the Feds hint at. And that will, again, have a big impact. Q1 of next year, first quarter of next year, 2024, I think that we're going to see some rates starting to come down. And if so, our spring market is going to be absolutely insane for the March onward and to February, but really March, April, half of April, getting into May. I think it's going to be super fun. And we'll see what shakes out of that. A lot of different opportunities. With that, make sure you pay attention to our investor course that we're putting online, understanding why cap rates are pert near worthless, or why cap rates are garbage. Anyway, just saying. If you need something, if you're feeling that giving need, make sure that you take a look at, hang on, let's pull this up. Rotary First Harvest is a fabulous way to be able to get out to the community. $20 of a donation gets 100 pounds of food for folks that need it right now, especially with our inflation and all of the additional costs that are involved. And it just, it just makes life a little bit easier. A few dollars can go a long ways. We will put the link down below for you guys. And remember, yes, you guessed it, smash that subscribe button. Let's have some fun. Make sure that you share this with people that you like. Share it with 2 people you don't like. And let us know what questions you have. In the meantime, enjoy your absolutely stunning and beautiful Saturday. And I will see you on the next video. Take care.